In our efforts to always look for better ways to look at the same thing, Gary, who's been a long time room guy from how long you been, Gary? With 2 years?
Yeah, just around 2.5 years.
And I think he was in a previous session that we did several months ago. He traded a lot of oil, still trades crude oil, right? Is that still your main market, Gary?
That is it, yes.
And what size are you trading in that?
It actually varies. My normal size is around, 9 to 12 lots.
So he's trading pretty decent size. That's really good size in a market that's as thin as crude oil. And so he's had success and he's been Dave. He's been around a while, but he's also implemented a lot of the order flow and now market relationship. Not now, but market relationship is what we're going to focus on with these charts today. What else did I want to say? Oh, I don't really know what to make of it, and we'll take it like step by step with the election and how it affects the market. Carl made some interesting points that when it seems the polls creep in Trump's favor, the peso gets hit and vice versa. And I know some people were trying to say that seemed like Clinton won the debate, therefore she'll win the election, and the market likes that, and it went up, and then it's come down. So I think that's a shotgun right now approach to it, and they're just spraying opinions all over. I didn't see any reaction that would have dictated. It's pretty subjective, right? It's not that objective at all. It's subjective as to what's going to happen and how it's going to affect markets. But there seems to be a clear relationship between how the peso reacts to some of the latest polls, and then some of these polls are all over the place. So you're not going to make a living or a killing on knowing who's winning a debate or who's going to allow you to get long or short at the right moment. So I wouldn't put a lot of emphasis on that. You guys know what really happened with the FOMC and the fact that there was a relief rally, but then they've come off of that. These are better markets when we're on the downside. And it's not for investors who are usually buy and hold, but it's better for day traders and the like because there's more two-sided, more turns, more price movement. Like today we had a great morning because prices just move. And it allows you to know if you're right or wrong because you'll know quicker. You know, sometimes what really sucks about trading when it's slow is you're like, am I right? And it's just not time yet, and I got to give it more time and room to breathe, or should I get out? And you're having to make too many decisions in a subjective environment, and we're trying to minimize those decisions to nothing, become reactionary where if it's not going pretty quickly to how good you are picking a location, you're probably early, you're probably late, get the hell out. So you're making less decisions because time is telling you what to do instead of trying to make really good sound decisions and you got money on the table. So, all right, so let's not beat that drum too much. What I see here first is, and I'm just going to say these are the first times I've seen these charts from Gary. I see oil, I see RBOB, I see heating oil across the top. I see crude oil at the bottom in black. Seems like it's one chart. And it's a 610 PNF at the bottom for crude oil. It's a 6 PNF in the upper left. It's a 10 in heating oil and RBOB. For those that don't know, heating oil and RBOB are products of crude oil. And so you could look at crude oil being the parent and the kids, heating oil, and RBOB. RBOB is the reformulation process of what gets cracked down into gas. So unleaded gas would be in this RBOB center top chart. Heating oil, there's a lot of people in the Northeast use to heat their homes. But that's what I'm looking at across the top. Gary, I'm going to let you take it and talk about what you were trying to explain to me in the trading room with building these charts. So why don't you just take it and go?
Okay, sure. Good morning, good afternoon, everybody. So how we have been, as Anthony already explained, these are the market relationships that I use for crude oil. So basically, so far, what we have been using is just a clean chart with just the PNFs in it. What I was trying to do is to make use of these market relationships in a better way, and I thought if I could add some levels which which update themselves dynamically and which are based on volume, then that would actually add some value to at least either it preempts a good location or it um, stops us from taking trade into a potentially poor location. So what I've done is I've added two profiles. Um, these are the ones that I specifically use for these instruments because these are very thin instruments. I don't know how they will react to a thicker instrument which is like ES that we normally trade. So we may have to make some adjustments based on the instrument. These are the settings that I'm using which work best for the instruments that I use for market relationships. So there is a bit of a subjectivity that depends on how it best fits you. So these are the two profiles that I'm using. I've thought of adding value areas and POCs from the current and the previous sessions. And I'm using first profile is price and trades, and the second profile I'm using is price and volume. So I'm just adding these these areas which update themselves dynamically. So that actually gives me a decent location to look for possible places where price can stall, or it can reverse, or it can continue. So
Wait,
as you can see here,
hold on one second. I don't want to remember where you left off. This is good. So you're not actually showing the profile. You're just, the lines are being placed on them. Value area, high, low, and PLC, correct? On the three different markets.
That's it. And I'm also using this divergence over here. So if any level comes up and there are multiple divergences, so I take note of that. That actually becomes a bit of a stronger level to watch out for.
Well, what's it at the bottom? What's the lines at the bottom? The red, purple, and pink?
It's a divergence. That's just tricks that I'm using for divergence.
Got it. Okay, yeah. I understand. All right. So what I like about this is you're comparing, contrasting three like markets and how they're profiling by each other. So go ahead.
Yep. So say for example, if you look at this crude chart at the bottom, from here it doesn't show up. These are the thin markets. So if you see this is a level over here. This 4650 on this. What is it? Brent is a decent level over here, and as you could see, there is a bit of a divergence building up on this as well on tricks. At the same time, we have levels over here in this one. So it's one high, the second high doesn't hold on, and the third high, basically there's a bit divergence over here as well. So this level is not there's indication that price may not go all the way. So once you see this happening, that price on these levels are price over here is trying to price over over here we have a decent pullback to this location. This is one of the EMAs that George uses, that I've used it. So this is a location that we already have. So what I'm watching for is when price pulls back to this location, what is happening with this at market relationships. So do I have a decent level that can stall the price? And here we have one decent level over here. This is basically this one. The pink level is the volume profile. So volume profile is a very strong level over here, and same over here. And we have a bit of a divergence going on. So this actually, if I don't go long here, at least if I don't go short here, at least I won't be going long. So this actually prevents me from going long. I'll be only looking for shorts until I have any further indication.
I love, I don't mean to interrupt you, but I love the implementation of comparing not just levels on a profile, but taking ancillary markets instead of how I use mostly market relationships the way I'm used to, and that is dome next to dome. But to actually have levels of ancillary markets next to each other, and maybe those levels are from our alert levels or from, in Gary's example, profile levels. Now you're profiling side by side different markets to qualify a trade. And what I liked what you just said was, if maybe you don't take a short, but it seems like you're not going to get stuck long, right? You're going to be buying into a level or potentially into resistance on all these markets.
And
Go ahead.
if you look back at these levels, actually act, they are very responsive. So over here, as you can see, price has been falling for a long time, and over here it just falls in this zone. This actually becomes a bit of a zone. So, and over here as well, I have the same levels plotted on crude oil chart. So once price is here, all these on these two, at least the way I qualify is I need at least two confirmation. I need to have these levels present and at least two of the market relationship charts. So if it's just present on one, I won't take the trade. I need at least two. So over here you can see this level is holding. Price got rejected on this RBOB, and price comes back to the same level it got rejected. So from here I can see that if it's not going down here on RBOB, I'll be watching for it. I won't be going short over here because it's already being rejected once over here and second time over here, and at the same time I have a level that is coming on this HO chart. The price did the same thing over here and again over here, and it closed above it. So, and also at the same time I have this volume profile level coming up on the crude. So this gives me an indication that I won't be going short. So
I really like that. I really like this. You know what's? Go ahead. I thought you were finished with your thought. Go ahead.
No, yeah, and also if you are really responsive, if you are very attentive, you can just take the trades whenever the volume imbalance or something shows up. Like say for example in this chart over here, as soon as you see this stuck shorts over here, they try to go short again, and then suddenly this volume imbalance shows up. If you want to use very tight stop, you can get a very good price at this level. So anywhere over here, you want to take a short, you can take a short, and you can get a very good fill and very good risk reward for your trades. So that's pretty much it. It's a simple concept. That's how I use it.
Yeah.
The same.
Go ahead.
Yeah. And if you are entering in the trade, then you have a. This also gives you a decent place to exit the trades as well. So, say for example, if you found an entry based on this market relationship chart, mind you, over here we have a divergence building as well. So it was a very good trade to take. And when you see these, the price is hitting these levels again, then you can actually, this is a level where you can actually go for a little bit of a higher target as well. That gives you a very good exit point for your trades. So you don't have to just scale out for 2 or 4 ticks or whatever. You can actually hold it for a little longer and wait for those levels to hit that. Then it can actually give you a better exit as well.
Well, it's actually taking charts and putting them out there so you're keeping an eye on other markets without having to catch it in dome to dome. Because I take for granted I see a lot more than other people can. Maybe some people see more than me. I don't know. But I could see, my mind's almost charting all these domes in my head. And when I get back to just the simplicity of, let me look at this, and this has helped me recently, is when I've been able to see a breakout coming in the NASDAQ and at the same time in the ES. We had one of those examples clearly today, like the win moment to buy a breakout, or at least not to get short some upside. Well, the NASDAQ had a nice head fake pattern and was taking off and releasing some buy stops right when we were about to. And then we did. And then when I say we, the ES, and up and away. So it's like you're crazy not to have charts side by side, and then to put profile levels on them, so you know he's looking for 2 out of the 3 to come into levels before he's looking to do something or not do something. You cannot trade 9 to 12 contracts in oil in crappy locations. You're just not going to do it. You're not going to be funded long. No matter how much money is in your account, you're not going to get away with it. You have to pick good locations. Are you feeling you're getting filled with that size most of the time?
Yep. When it totally depends on the volume. So if the volume is higher for the session, I get better fills. Otherwise, sometimes I don't get the fills. A couple of contracts are left behind.
And you've grown a callus or become immune to the monetary swings in a way, correct? Or just become numbers to you?
Yeah, that is. I mean, more as my experience has grown. I'm more of I just trade from location to location. I don't bother about what is happening. With the money, because if the location is crappy, what's the point looking at the money?
Well, that you're focused on being consistent, and you use the word simple.
Yep.
I'm a simple guy, and it's why didn't I think of those moments? That's important in these meetings. Now, these charts have to be rebuilt exactly the way they're used here. Just the concept of profiling different things side by side. Someone asks, what's the yellow and red blue lines? The yellow, are they just on the bottom chart?
These ones.
Yeah.
These ones are the TPO levels. Again, these are the ones that I use specifically for crude. So I don't know how well they're going to work for other instruments. So I use these TPO lines as well. They sometimes they react very well. Again, you have to watch the dome and the size and everything else. So it's not just like standalone thing. Everything has to come together for you to place a trade.
Yeah.
But this gives me a decent location on where I should be looking for entries or exits. So
could you give me a sense of pull that other chart that you had with the filter on it? You pulled that over earlier. This is a crude oil chart with the filter. So this is a 10 PNF, right?
That's it. Yep.
Look how nice that 44.50 worked, that thin spot on the way, that big long down bar, and it comes back up to it. 44.55, yeah.
Yep. And we can.
Then the global cursor, that's vertical, so you could see what the hell these other markets were doing, at the same time. What are they doing at the same time?
So in this case, this was a better level. This again is a TPO level, as you can see on the black chart.
Mm-hmm.
And at the same time, we have this volume profile levels over here and divergence building up on all the charts.
So they were all into some upside resistance levels potentially.
Exactly. So if you can already see there's a very big downtrend going on, and price just tries to go up. It was a bit of a shakeout. There's too many shorts, and then it again went down.
How many trades are you making a day, Gary?
Well, it depends on what sort of activity we get, but usually it's about between 8 to 14 trades, 8 to 15 trades. So.
And you were struggling in August, and you got most of August back in late August? Was that just from the chat back?
It was the very last day. I don't know, it was Thursday or a Friday. There was some news, I think, that moved the market, and that's where these levels actually came into handy as well. And one more thing I would like to say is, the more these levels, come together, come closer, the better the location becomes. So sometimes, they are like spread wide from each other. As you can see, like this level, the closer they come, the more responsive that zone or that level becomes.
Hey, put your cursor over the thin spot on that big long down bar. Right? Okay. Go over to the left. No, to the right. To the right. Right there. Left. Right there. So right there, let's look at what heating oil and RBOB was doing. All right, now go to the right a couple. Right, and two more. So this rallies up. There, come off. I'm just looking to see, a good way to look at this potentially would be have like a thin spot market relationship page, where you're like Find your ancillary. I call them complexes. Build your complex up, meaning your energy complex would be oil, heating oil, and RBOB. He ain't looking to trade heating oil and RBOB. He's looking at where the products are that are going to relate and influence oil and vice versa. If you guys are, obviously most of us are just stock index traders, build your index or complex up of indexes. And it should be NASDAQ, Dow, Russell, DAX, and Euro stocks. There should be 4 to 6 of them. Your metals complex. You can build pages and really create good core relationships and then start to implement your time frame and how many trades and what levels you want to trade in. Maybe you don't put on a thin spot trade unless you have 2 or 4 of your complex going into a thin spot together. There's just so much powerful stuff that when you are able to confirm it with a market that relates to it is the power of valuing price and timing out a location. He's not trading 9 to 12 oil contracts in bad locations. You just can't do it. You just can't. You'll get clipped.
The money just disappears fast in the blink of an eye.
Yeah, it's, you're not going to, you're just going to get scared quick. And if you don't, you're just going to devalue money to the point where you just want to get it over with. And that's like a guy gambling. He just throws all the money in. He just wants to be done. If he wins, fine. If you lose, he's just sick of getting beaten up and the edge is against you. But you don't build your size to that point in that market by just taking shotgun approaches to entries and exits. I like this concept of TPO or volume profile levels, compare, contrast in ancillary markets. Do you trade any E-minis, Gary?
I tried it, but the best time for me, since I'm so used to little bit faster volatility, right. So I do trade them time to time, but only when the volatility picks up. So if it's like usual grindy times, 10-point ranges, I don't trade them. Once the volatility picks up, like towards the end of the year or something, then I do trade them.
Does anybody else have any questions for Gary? This has been recorded. We'll post it in the next few hours up to kind of review it. I would encourage people to build your own complex market relationship complex page up, or just have these charts that come on over. A handful of guys are thanking you for your time and your sharing.
Yeah, no worries.
But this was cool. I like it. And it fits to what has been helping me in a couple instances, getting me out of trouble, is waiting for the NASDAQ pattern to kind of confirm a breakout. Because when I'm trading worse is when I'm buying highs of a breakout, potential highs of a consolidation, selling lows, and I do it twice, and now I'm mad because I buy it at 46 and it goes to 44. I get short at 44 and it goes to 46. Now I'm looking for someone to tackle. So when you're able to let something help kind of nudge you in, sometimes it just cracks you in the head and gets you in quick. That's when markets are trading better. Sometimes it's just a nudge, like a tap on the shoulder and say, "Oh, not now, not now," and it keeps you from spinning around and worrying about missing something because you didn't get that nudge or that confirmation from an ancillary market. Great stuff, and I guarantee you, 95% of oil traders. Retail mostly in this business. I would say almost 100% of retail traders, but 95% they don't watch the ancillary, the RBOB and heating oil. And I don't. For edge guys, I think I've said it. Long-time room guys that ask me, I say it. You don't hear me say it a lot in the room because I don't share with oil guys unless they come into the edge or they've been in the room a while. The complex you have to build in oil is heating oil and RBOB, and 95% of oil traders don't even know what those two things are: heating oil and RBOB. They don't even know it, and yet they're very influential products of crude oil. I mean, if you don't crack oil down into something, it's a useless resource. So, again,
if I don't use it, my profitability drops to less than 50% if I don't use this relationship. So
there you go. And then you get on the confidence to build your size. Less size when you're successful, less money, and around you go. But all right, well, Gary, thanks again for sharing. This was a great webinar. I'm going to stop the